Hey everyone, welcome to this week's weekly chat. For the first time ever, it might be the time to sell if you meet these criteria. Watch to find out. Hey everyone, welcome to this week's weekly chat. Of course, you have Alex Wilson, team lead of alexjwilson.com, and our director of operations, Kyle DeVigi. So Kyle and I have been talking a lot since the last weekly chat video, and we've been reviewing the market since then, and we're both seeing a storm cloud that's starting to brew, but also added there will be sunnier skies ahead. So the positive thing, over the last 2 weeks, we've seen an uptick in the market after being dormant for the previous 6 weeks. During this period, condo sales fell nearly 80% downtown. But prices maintained their price point very strongly. The reason being is that new listings fell 60%. But there's a big but to this right now. And here's the thing. When we look at the rental market is really going to be a bellwether to what's going to be happening in the resale market come the fall and getting into 2021. We currently we've never had this many resale lease listings before. We're at 20 plus lease listings. Kyle has lease listings. We're getting calls from more people to lease their units. And we've had that many units for lease before, but typically it's a new building coming into occupancy wise and just an absorption period. We have a whole bunch of new units and a new building coming on, and it may take a few months to rent those out.
There's some buildings like that, new developments that literally have 65 units available.
Yeah.
And that's just because the building has registered recently and they can rent it out freely. But also, again, Alex, I want to bring up the Airbnb factor, which has had a huge impact on the market overall. And that's why there's been a flood of all of these new listings, lease listings on the market.
Which in a normal circumstance would not be an issue. But we're not in normal circumstance. So again, we addressed some of this last week, but again, we took some more time thinking and reviewing things. So we also talked about last week that on the lease side, so again, on the sales side, things stayed fairly level. Demand went down, but supply didn't increase that much because people just weren't putting their units on the market wise. So prices held firm. On the leasing side, saw a totally different story. We saw new listings shoot up 250%, inventory increase wise. So the inventory increased 250%, and demand shot down nearly 60% wise. So my sale listings are selling, but my lease listings are just sitting there, and I'm not getting any showings on my lease listings. So that's today. Now here's what's going to happen. We've talked about on last week's video our expectations for the educational market coming in the September. Usually in September, you have all the people that are going to be attending university coming in, post-secondary institutions, colleges, everything like that. If you read the papers now, we suspect it, and it's a reality. You're going to have a huge online component for post-secondary institutions in the fall. Also, borders are remaining closed. So not only are we not going to get the international population, I'm sure there's going to be a lot of individuals domestically wise, but maybe not local to Toronto. Both Kyle and I went out of town for university. You're going to see that domestic audience, they're not coming to town, or there'll be a reduction in that population, and that international population really isn't coming this year. So that's, again, over 100,000 students that aren't going to be looking for accommodations in Toronto this year. On top of that, with our immigration, we are a province, a country that relies on immigration for economic growth wise, to replace our low birth rate. And we do that very, very, very well. We're not going to get anywhere near the numbers we have been getting. So where we see this, the cloud storms is, okay, new listings on the sale side, they've decreased with the decrease in demand wise. And the positive thing with the pause in the market in April wise, there are hungry people that have come back to the market and they need places to live. People need places to live. So in the stock market, we call that a dead cat bounce. So it's come in, boom, and it bounced up a little bit. So we're seeing the little bit of bounce up. But truly, how long can landlords bleed money on their rental listing units? There will be a time when a landlord's going to make the evaluation going, you know what, I'm going to take some money off the table. I'm going to start listing my unit for sale. So now we're going to see a switch over because, okay, well, my unit's not leasing wise for the number that I need it to or want it to. I'm going to sell my unit instead. So then, yes, we'll see a decrease in our lease listings wise, but not because it's got a lease. It's going to be reallocated now to the sale side. So now we're going to see an increase in the listings for sale. But as I said, immigration wise, we are an economy that relies on immigration growth wise. Immigration numbers will not reach what we typically experience. So we're obviously going to see a decrease in immigration, borders are closed, all those various things. Decrease in immigration, and they are the people that help buy these units as they come to the country. They need places to live, those various things. So now again, my pool of buyers has decreased. So we're going to see an increase in the number of listings for sale come the fall because as that international student population hasn't come in, more people will be giving their notice for their units wise. They'll be moving out. We'll have new inventory coming on the market wise. And we'll have empty units. So it's either drop your price for lease wise or sell it wise. So increase inventory coming onto the market wise. So in the fall, real estate prices, we actually expect real estate prices will, on the resale side, will probably may take a hit and may go down due to the amount of units that will be coming on because of landlords that are going to be exiting their units wise. So we're really seeing the leasing market as a bellwether for a potential decrease in the valuation of condos in the downtown core coming up in the fall and early 2021 market. So that's the cloud storm. The storm is starting to brew. There's clouds in the sky. If you go back and look at our videos, Kyle, have we ever talked like this before?
No. Absolutely not.
It's always been sunny skies. Now, here's the good news. The good news is that all the things we said before about the sunny skies previously, those still all exist. Those haven't gone anywhere. All those rationales in regards to supply issues, I feel like I'm talking about two sides of my mouth because I said there's going to be increased supply, but there's going to be supply issues, infrastructure issues, robust immigration-wise, Toronto being the economic capital of Canada, our strong tech sector, our strong banking sector, our strong post-secondary institutions, all those things still exist. In 2020 and 2021, we just have a worldwide phenomena that has put everything on pause. So those things have not gone away. They're just not accessible and able to operate as in a normal economic environment. So those are all going to come back. We are, again, just in our short-term situation-wise. But in that short-term situation-wise, there are people that are going to be impacted. So this will be the first time I ever say this, and it may be the only time I ever say this. It may be, depending on your situation, a good time for you to sell. And Kyle corrected me. He's like, not sell, yes, but what are you actually doing when you're selling?
Well, you want to simply reallocate that money into another asset.
Yeah. So what we're looking at, and there's a specific criteria for you to sell. So number one, your unit has to be built before November 2018. Here's the reason why. If your unit was built before November 2018, you are a rent-controlled unit. So we are now in a negative situation for the leasing market, as we discussed was. So if I were to, and everything will rent out, everything has a price, everything will rent out eventually wise. It's just, what do you have to put that price to? But in order to get my unit rented out, I'm going to have to decrease my rent by hundreds of dollars. I'm gonna have to decrease my rent by hundreds of dollars. Now, if I'm under a rent-controlled unit, I don't even know how long, it's taking me 10 years to make up that difference in rent-wise that I'm going to get now versus 2022. So that spread, when my demand goes back up to regular levels wise, it could take me 10 years to recoup the hundreds of dollars I'd have to decrease my rent because I'm under a rent-controlled unit and I can only increase my rent by the provincial prescribed number, which this year was the largest. I don't know if it was ever or very close to it, 2.2%. Usually it's in the ones. It's been below 1 before. So very incremental. It doesn't even meet the rate of inflation wise that I can increase my rent on my unit wise. So rent controlled units, that's number one. If you have a rent controlled unit, okay, you met criteria number one. Number two, if your unit was built in 2017 and you're rent controlled, I don't think it's the right time to sell. It's still not old enough yet. It still has room to grow wise. But, if you're that 6-year-old plus building, definitely 8+, it's time to start considering things, because on the other end, if you're in an older building wise, your unit is bigger. And when you have a bigger unit, that means you have a higher maintenance fee. But your comparable 1-bedrooms will rent out for the same for the newer building across the street. Heck, that newer building across the street will probably rent more than your older building was. So in your older building, not only are you rent controlled, but you have a higher maintenance fee because you have a larger unit. And the maintenance fees are simply calculated by the square footage of the unit wise, that's the percentage ownership in the building, multiplied by the whatever the number is for the cost, divided by all the square footage in the building wise. So you're just naturally going to pay a higher maintenance fee because of the size of your unit wise. Maintenance fees and rent are bad because your maintenance fee is not I don't make money on a maintenance fee. It's just a pure expense on my balance sheet. So if I'm 6-year-old plus, I'm typically in a larger unit wise, which is going to lead to higher maintenance fees. On top of that, depending on how the building is run, I may be creeping up to just a natural wear and tear higher maintenance fee wise. I have seen some older buildings in the 70 to 80 cents per square foot, where newer buildings are in the low 60s per square foot wise. So I have a larger unit and I'm paying a higher dollar value for my unit because it's a little bit older and there's more wear and tear in the building wise. So that can be an issue as well. So now I have a higher cost basis for my unit wise compared to the newer units. So I would say anything 6+, again, hits the criteria wise. Okay, let's explore, if it makes sense to sell this unit right now. And then number 3, it really just depends on the spread of your portfolio. For example, Kyle and I were talking, I have a unit under rent control. Kyle in the same building has a unit under rent control. The rents actually on our units are so low because we have original tenants in there. Even if our tenants were to leave at the reduced rent, I'd have to rent my unit out. I'd still get more rent for it. So we're not personally looking to dispose of our rent controlled unit. So it really depends on the spread of your portfolio and how it's structured wise, if it makes sense to exit that specific asset. Now, Kyle, why don't you talk more about reallocating the asset wise? So if you meet all the criteria, so number 1, rent control, number 2, the maintenance fee, age of the building wise, time to disperse of that asset. Number 3, consultation, look at the portfolio. Okay, makes sense. What do I then do once I do this?
Yeah, exactly. And it's kind of taking the flip of that, where essentially you want to be reinvesting in pre-construction condos. So new buildings, new units that aren't subject to rent control, that are 4 or 5 years out. You know, they have to be constructed and built still. So going to be well past the COVID crisis. Things should return to normal then. And then hopefully we'll see those sunny skies again at that time. And then also the maintenance fees are going to be very low. Traditionally, they are starting around about 60 cents a square foot for new builds. So, you know, quite low. And they also have separate utilities that are metered and paid by the tenant as well. So you're offloading those landlord costs that you have. So not looking to get out of real estate, just looking to put it into a different real estate asset that might be better producing given the current situation out there right now.
Correct. And really these pre-construction opportunities, we're looking at opportunities that are completing in 2024, 2025. That's where we want to reallocate the asset to. So basically what you get to do, you get to still participate in the real estate market, but you avoid all the headaches involved on the leasing side and the potential vacancies and the cash flow costs and everything like that that are going to be impacting your current portfolio. So Kyle hit it best. We're just reallocating the asset to a different real estate class of investment wise, really putting an option on the future value is what we're doing, and avoiding the current situation. And I think it'll be the only time that we say sell wise. And again, why we're saying sell now, because if you call us in the fall, we will still be able to sell your condo. It may just be for less. Or if it's not the fall, then it'll be in 2021. It'll be for less. So that's where we just see some opportunity now to catch the dead cat bounce on the bump in the market wise. But we do see a storm brewing ahead due to the leasing market. And there are bears out there. And this is the positive wise. And what I mean by the bears wise, there are people that are going to be buying these units at a set price point in the fall and in 2021. They're going to take advantage of these opportunities and they're going to pick up these real estate assets. And we've had conversations with them and they're waiting for this. And normally I don't agree with them. But looking at the leasing stats right now and what we're expecting, the conversations that are happening, I think it's going to be, it's more likely to be a reality now. But it's, again, all short term. So it just really depends on what you're at. Oh, I forgot. There's one other criteria. One of the most important criteria. If your unit is vacant and your tenant has given notice. So we're not looking at selling units that currently have a tenant in them. We're looking at units where you know the asset is going to be empty. I can't believe I forgot that. That's one of the top criteria. So let me reiterate the criteria. Number one, you're a rent-controlled unit, and I'll answer that a little more specifically. If my building was built after November 2018, I can lower my rent. It doesn't matter. Once the market gets better, I can jack my rent again. So I feel bad saying that. I shouldn't say jack my rent, but I have the ability, the flexibility to take advantage of market situations if rental rates are increasing wise, and I have the ability to increase my rent in the future wise. I have the flexibility to adjust that. Rent controlled, I don't. So that's why if it's rent controlled or if it isn't rent controlled, that's why it makes a difference. Number two, if it's 6 years plus, and then number three, it's sitting there vacant currently now, or your tenant has given you notice wise, so you know it's going to be vacant. Those are the main three criteria. Then number four, depending on your situation, through an evaluation wise, if it makes sense. Then step 5 is reallocating the funds. So that's where it actually makes sense for you to consider selling a unit. This may be the only time I say this. And you're not really selling, you're reallocating. You're trading in for a superior asset down the road, ultimately what it is. Because when you look at that unit now, if it's 6+ years old, and we go ahead 3, 4, 5 years, now we're getting near to 6 years. Now we're 9 years and 9 years old in 3 years. And if it's older than that, now we're 10+ years old. Now it's getting even more dated wise. Definitely getting to the state where it needs a renovation. All those additional things are coming up with the property wise. And there's some uncertainty in that next 1 to 1.5 to 2 year mark, where we're not going to be able to capitalize. And that was at the time we want to capitalize. So that's where the conversation is, where you are in your investment cycle wise, and if it actually makes financial sense for you to disperse now and reallocate the asset, because you don't want to be in that timing wise when you're selling in a bad market. So overall, that's my thoughts. Anything more you want to add, Kyle?
Yeah, just to recap that this is short-term pain that we're going through, situation due to COVID-19, but long-term, again, we strongly believe in the fundamentals of the real estate market.
Yeah, and interest rates aren't going anywhere either. Interest rates are still going to stay low, and all those your interest rates probably when you get your property, if you buy pre-construction wise in 2024, 2025, will be lower than they are today. The reason is interest rates are low, but they're not as low as they could be with the current bank rate that's out there. They have the ability to go lower because of liquidity and bond rates. They are a little bit higher relative to the situation what the bank rate is. You can expect those to be lower in the future wise, which will help fund future growth in regards to real estate values wise, but also bring down your cost basis and your bottom line into the future wise. So other reasons to look at as well. So anyways, if you guys fall into that criteria of having that 6+ year old unit that's coming up to vacancy wise, I would say that we should book a chat, either myself or Kyle, and see if it makes sense for you to keep it in your portfolio or to trade it in or reallocate it to something else. We'd be happy to have with that, because what we ultimately want to do, it's a long-term game, and we want to build your generational wealth, your financial freedom, and help you minimize your stress. And I will tell you, if you have an empty unit and it's stressful, so minimize your stress and maximize your wealth. Okay. So Alex Wilson, Kyle DeVigi from remaxwealthbuilders.com. Hoping to speak with you all soon. Talk to you later.
Bye, everyone.